case study by now, have some understanding as to what the company is. It's company P, which is a distributor who is into distribution of plumbing equipment, building material, etc. So that's the type of the case you all have gotten this time. It's very important for you to understand this performance strategy subject. People say this is the subject where you test the general knowledge. When you go to the exam, sometimes people realize or sometimes people find it difficult to relate it to a particular topic you have studied in class. Which topic is it tested, or is it just common sense, the CIMA exam testing? So this is the so-called general knowledge paper. Obviously you have the theoretical areas coming in, but a lot of common sense, a lot of practical thought will be tested at this exam. So especially with regard to the case study, that's where a lot of your practical knowledge will be tested. So I will base my lecture today on some practical elements, on some corporate examples, and as to how you can relate your theory which you have studied in the class to the case study, where the student is expected to bridge that gap of the practical application of the theories you have learnt. So that would be the base of my lecture today. Just to take you all through the types of risks this company P can get exposed to, and the examiner could test you on these lines as well. These are the main risks, as you can see on the presentation. Company P can get exposed to strategic risk. I'll come to the definition of this. It can be on the note of financial risk, on currency, on exchange rates, on interest rates. It can be on the aspect of legal and compliance, which is a hot topic now in the world. Or it could be on the face of operational risk, the day-to-day, the nitty-gritties of the company. So these are the main types of risk which could get covered in your examinations as far as risk is concerned for this case study. Strategic risk. What is strategic is strategic risk in definition. In definition, strategic risk is company's strategy not being able to give out what the company is having as an objective. You all know a company will always implement a strategy to meet their final visions and the missions, and you know the definition of strategy, that is how to get to the mission or the vision, or how to achieve the company's objective. So strategic risk is the actions you take not helping you to meet your final objective. So what could be the strategic risks this company P in your case study face? Number one can be in the form of the recession. I'm again relating it to the modern, current, present recession levels in the European sector, and especially in North America as well. It could be in the form of severe competition, because most of these products in nature is a generic product, or it could be a part of the overall project itself. So I've split the strategic risk into three aspects in this scenario. When it comes to recession or economic risk, it is obviously a high risk. Definitely P's performance depends on the level of activity in the new construction and property repair and maintenance markets. Definitely you all know this is a sensitive market, and if the economy is not doing so well, definitely people will not spend too much on building, repair and maintenance. This becomes a luxury good. Definitely if the economic conditions are not helping to have a spare amount of money for consumers to spend, and that's the case in any country. For a matter Sri Lanka, that's the case. If you do not have that proper economic condition, or if the country is going through a recession, you will not have spare money to spend as such, and obviously which could adversely affect the company's performance. So recession in that way is an uncontrollable risk here, more or less, but is a huge risk this company could face. And obviously taking the present levels of the recession, as you can see on the slides as well, in Europe and North America, the countries, most of the European countries are facing huge recession, and this could be tested at the exam also, because what CIMA expects is for you to have a general understanding as to how the world economy is moving as well. So when you write an answer, you need to write as if you are writing or you are working in this company today, and you are giving recommendations based on today's economic levels. So they will definitely expect you to talk about the general trends. They won't expect you to know the numbers of inflation, what is the GDP growth in each of European countries. That's not what they expect, but a general norm as to how the economic conditions in the European region and in your North America is varying. And definitely it is not the best time for these countries, and which could be a part of your examinations as well when the unseen comes. Factors which could influence this risk, this is a little economic theories. Again, the rate of GDP growth, the consumer confidence of this will come through the economic developments as well. The availability of credit is another factor. The interest rates, how high or how low interest rates are, and obviously you all know lower the interest rates, more tendency would be there for people to borrow. And higher the borrowings, people would want to invest in property, and there you go, you have significant demand for this particular industry. So this is where you relate this industry to real economic needs, and then how you bridge that gap again. Moving on, like things like mortgage and interest, the level of government initiatives taken, and the inflation itself. These are factors which could actually have a significant impact on this particular company P. Moving on, the next steps. Now, what could this company do to mitigate these risks? What are the actions they can take? Just to take you all through the points, if you all can see the slides here. Obviously, information would play a huge role. Data management, keeping on understanding what the statistics are, and how do you share it with the top management for them to make quick decisions and key decisions. So the information systems, your ISs will come into play here, how efficiently you can manage data and information. Obviously, like I told you, information systems could be a critical part of it. Then definitely you come to that obvious point, that is the cost reduction. How well companies could work on their cost reductions, how can they apply principles like Kaizen costing, how can they make their operations more lean without compromising on their qualities. These aspects will definitely be covered in your exams, because this is exactly what the companies would do to ensure that they sustain even in the period of a recession. In the light of changes in the market pricing, definitely you need to understand how your margins move. One mistake most corporates in the world, even for a matter in Sri Lanka, is what they try to do is whenever there's a recession environment created in the country, they tend to curtail prices and forgetting the fact that their margins are getting eroded. So is that the best action of this company could take is a question mark, and your answer should depend on whatever the scenario should be. But definitely a cost reduction is a possibility. How well will you manage your erosion of the margins is again up to the company to decide. There will be a dire need for better planning, better logistics, better supply chain. How well can you integrate or backward integrate along with your value chain? These aspects will help the company to efficiently improve on their logistics part of it, which will help them to reduce costs, which eventually can get passed on to their final consumer. Now, this is how a company could look into the future, foresee the future trends, and figure out how to face them and minimize their risk. So that's in terms of strategy risk. I will go on to the competition risk after this short break. See you soon. Welcome back. The next risk I want to talk about is on competition risk. What is competition risk? This is the risk created by the competitors of the company. If you take the product itself and the company itself, these products are very generic, and you will see so many competitors having the same product being produced, lots of price cuts, lots of duplications. So in this sort of an industry, competition risk is very, very critical. If you look at the screen as well, I have given you all some thoughts into this, and definitely increased competition in the regions could result in a downward selling price trend, and this will definitely erode the margins. This will definitely disrupt the company's operation, which will lead to another problem. And then trying to address this risk, there will be compromisations on quality, etc. happening for this company as well. So competition risk again is a very, very critical factor. how do you mitigate this risk? Now, the important point here is that the company should work. If you look at the strategies available, the company could work on a differentiation strategy. Most companies who produce generic products use this. So what can you offer your customer which someone else cannot offer? Things like the services, things like speed, all these innovative products which will differentiate you to another competitor who is just simply offering the product itself. So in an industry like this where things are little generic or more or less generic, you'll have to use the differentiation strategy to ensure that you remain competitive. One point to remember in these subjects, they say always strategic level, the first time is the easiest level to pass, or easiest time to pass rather. Why? Because you are expected to integrate your ES knowledge, your FS knowledge and your PS knowledge whenever you write any of these exam papers. So when you have studied the strategies possible, the differentiation, the cost leadership, stuck in the middle, whatever it is, do not be afraid to use these in your PS exams also, right? Please do that so that you show the examiner it's risk management, but what are you suggesting to mitigate a strategy which is more on the differentiation line. If you go on the other mitigation actions possible, what else could you do? You can strengthen your distribution channels. This is where again companies become a little competitive than their competitors, because these are very, very generic products and these companies purely into distributorship. So how do you ensure that your distribution channels are strengthened to ensure that you have reached unreachable areas in the geography in the world, so that people, even your competitors, will not be able to really penetrate across the regions you're working in. So that's another point where I can suggest as a mitigation of risk. The other risk is again people is on the project itself, how the project could run into a risk. Definitely, it's important that you keep on bringing in new technologies. You cannot have a situation where your product is becoming obsolete. So it's very important that you continue to invest on R&D, continue to bring in new technologies, and the speed to market. How soon can you bring in? Can you bring in before your competitor does it? Can you bring in before someone else in a different region does it? And how, depending on the speed you bring it to the market, your competitiveness will lie. So again, investment on new technologies, etc., will be very, very critical. And obviously, the ability to successfully execute these changes in technology will definitely hamper your existence in the market as well. And definitely, I hope you understand, if the company fails to do this, they will lose its existence, and there will be severe disrupts to their existing operations. Profitability will get disrupted, and there comes the quality compromisation, and that's where companies lose as well. So it's very important that you keep a sustainable business model running in. That's what I've discussed over here, how to mitigate the risk. The research and development component will be the key here to ensure that you keep on identifying new customer needs, which can be that differentiator for you as well in terms of the product you offer. The importance of the technology will be very critical. The importance of assessing and keeping a track of KPIs will be very critical to ensure that you're meeting the customer needs and you're always up to date in the industry as well. The progress in a lot of projects should be kept quite a close track of, so that you don't really is cutting short on time or cutting short on the qualities or whatever, just to ensure that the new projects you come up with is actually running smooth. The next big one, which can be an obviously a testable area, is your financial risk. How can you be exposed to a financial risk? This can be in the form of a currency risk. This can be in the form of an interest rate risk, because these companies are such that they'll be buying in from lots of original manufacturers, you can call it, the OEMs. They'll be buying it from different regions, different countries. They can be paying the suppliers in different currencies, etc. And this will be redistributed to the customers or the agents, and they will be buying at different prices also. You can't expect people to pay in a foreign currency and buy such a generic product. You don't see that happening in this world. It can be a car which is sold in dollars or yen, but it can't be a small building product or an electrical fitting rather which is sold in dollars. It doesn't make sense in a localized context. So definitely currency risk will be a critical factor, and how do you manage this can be tested quite probably. Then again, along with it comes the borrowing, so definitely you can be exposed to interest rate risks as well, and that can be a part of your questions as well. This is, guys, covered in your syllabus to an extent of about 25 to 30%. This is a little bit of a grey area. Students don't like it. Some students like it who love the calculations, and you always have this mentality, should I attempt this question or not, or should I really leave this area when I'm going to the exam? My recommendation would be you cannot leave anything when you go to the exam. Definitely you have to be prepared for the entire syllabus, and especially when it comes to this case study, you will see there can be substantial biasness towards the financial risk area also. So it could be a question in section A where you will be compelled to do it. So if you don't do it, you will probably lose the mandatory marks available. So be careful in that note. So definitely these operations, like I told you before, can be funded through different ways of financial instruments. Can be cash, can be liquid, can be initial public offerings, they can decide to float it. All these things could come into play. Again, like I told you before, there could be a question on an IPO which is more, let's say, FS related, but could get tested over here. So when you all study and when you all write, integrate your answers always. How do you manage risk? This is where the derivatives come into play. Your options, the swaps, the forwards, the futures. It can be the exchange rate swaps, options, forwards, futures, or it could be the interest rate derivatives as well. And there could be a numerical calculation tested as well. I will take you all through some of the derivatives. I will take some time to take you all through some of the derivatives. Students find it a little difficult to apply this calculation at the exam, and obviously with the tension also. So try to grasp some of the calculations I will take you all through, and which could help you all to maybe clarify some of the doubts you all have. When it comes to, I'm deviating from the case study for a little bit and taking you all through this theory of hedging, just for you all to give some insight as to probable questions at the exam for section A especially. So hedging can be done. What is hedging, first of all? Hedging is where you minimize risk, or you try to eliminate risk. One thing to be clear out is that hedging is never done to make profits. That's just a misconception people have. Hedging is done to minimize or to eliminate risk. So how can you hedge? You can hedge it internally. That's where no third party, no derivative gets involved. You do some adjustments in your company, within your company, to eliminate or reduce the risk. And obviously external hedging is where you use the derivatives available in the market to minimize or eliminate your exchange rate or interest rate risk. What are the internal hedging techniques when it comes to exchange rate management? I will take you all through the internal hedging techniques quickly before the break, and after the break I could take you all through the external hedging. Internal hedging, first one available is leading lagging. This is a very simple theory. This is where either you delay the payment or you make a advance payment, depending on your perception on the exchange rate. If you feel the exchange rates are depreciating, let's say in the context of Sri Lanka, you are an importer, you think the exchange rates will go up or depreciate in the future, you think I'll quickly go and make the payment now before things get worse. Right? Simple as that. You do it for your CIMA exams. If you think that the exchange rates are moving up, you will quickly go and make the payment even before the deadline stipulated for you all. That's called leading a payment. Similarly, if you feel the exchange rates move the other way around, you will make a delay in the payment as well. Then you have the matching principle. What is matching? You match your income with your expenses. You have revenue in dollars, you have your expenses also in dollars. Can every company do this? Answer is no. You need to have the bargaining power. You need to have the power to match this. You need to have the power to demand your suppliers to invoice the product in the same currency you are earning your revenue, etc., etc. So the demanding power will come into play here, but that's definitely a tool people can use. quickly take you all to the other two. One is pricing in own currency. This is where a Sri Lankan company could simply export to, let's say, UK and tell the UK customer, you pay me in rupees. So you pay me in rupees, my costs are incurred in rupees, rupees match, and that is a natural hedge created in the company itself. And the last one is netting. Now what is netting? This netting is done when you have subsidiaries. When you have subsidiaries in 2 countries or 4 countries or whatever, the subsidiaries in those countries will have intercompany payments. So without letting those subsidiaries pay each other, you bring it to a central point and you say, let's say Sri Lankan company owes India, India owes Pakistan, Pakistan owes Sri Lanka again. You net them off and you make little transactions. Your transaction values will come down, your exposure to currency risk will come down, and you would benefit as well. So those are the internal hedging techniques available for most companies, and if with regard to company P also, they can definitely use things like matching, things like pricing in home currency, and even to the extent of using netting to ensure that the exposure to the currency risk is somewhat mitigated. I will take you all through the external hedging techniques right after this break. Welcome back. Coming up to external hedging techniques. Now, what are the external hedging techniques available for companies to hedge against their currency risk? You have the main 4 derivatives, that's forwards, futures, options and swaps. I'll take you all through some of the calculations for these 4 derivatives so that it will help you all to understand the nitty-gritties here. What is a forward? Just to give you all a brief idea, forward is a contract which is agreed today for a future transaction. Important definition. Now what are the characteristics here? Forward will give you a specific rate, it will fix you the rate, but it will tell you you have to use that rate on a particular date for a particular transaction value. So they fix the rate, they fix the date, and they fix the transaction value as well, which obviously leads to the demerits as well, because companies to fix a date for a transaction and to fix a value for a transaction becomes a little difficult, and especially when you're dealing with a company, if your company is not as powerful as your supplier or for a matter of your customer, you might have problems in getting a payment or getting a payment done on that particular day. So this leads to little drawbacks of forward contracts as well. Anyway, coming back to the characteristics, this is called an over-the-counter instrument. Now what do you mean by an OTC instrument? This is where any 2 parties can come into a forward agreement. You don't have to go to an exchange like in the form of a futures to create this hedge. Any 2 parties can get into a forward contract and decide how they are going to help each other to ensure that the risks are mitigated. Obviously it has its own conditions. If you fail to honor the obligations entrusted on the party who is taking the forward, for an example, if a bank offers a company a forward agreement on, let's say, exchange rates, and if you fail to convert that currency amount on that particular day, for an example, or if you can't match the transaction value, this is taken as a breach of contract, and it is actually leading to a level, it is equivalent as you not honoring a debt payment, simple as that. So it will be a breach of contract. It would probably sometimes lead to a scenario of your credit ratings being degraded, etc., etc. So that is critical, and those are the drawbacks of forwards as well, coming through the characteristics of the forward contracts. Forwards are not available in all currencies. Sometimes even in the context of Sri Lanka, it took some time for the Sri Lankan rupee and the dollar, sterling also to come up to the level of forward compared to the other countries in the world. So forwards may not be available for every currency. So those are some of the drawbacks you will see in forward contracts. You have another form of forwards which is called option forwards. Now what is an option forward? Option forward gives you that flexibility when it comes to the date of exercising the forward. I told you all the typical forward contract, they will specify a particular date, whereas option forward will give you a little flexibility. They will say within this week, within these 2 weeks, you come and exercise your option. So there is you come and exercise your forward, and it gives you the option of choosing the date you want. So there is some flexibility in option forwards. Now, good example is, for an example, W Mode is a worldwide company, a famous company, who was able to save close to about 12% on their top line thanks to forwards, and they've been using forwards aggressively to ensure that their the receipts are hedged using the forward contracts, using those fixed rates, and they were able to make quite significant gains. And more than that, you ensure that your cash flows are more certain, and that's the biggest benefit you can derive out of it. A small example for you all, you might get a scenario like this. They will say, I'm not going to take you all through the entire question, I'm sure you can see it on the screen as well, but they will give you a scenario where there's a receipt or a payment due, and they will give you the spot rate and the forward applicable as well. And they will ask you, if you are using the forward as a hedging instrument, what could be the outcome. So if you have used forwards, you will never go and use the spot rate in 1 month's time to convert and see what your final outcome would be, because you're bound to use the forward rate. You're bound to use the forward rate. So irrespective of whether it's a favorable rate in the spot market in the future or whether it's an adverse rate, you're bound to use the forward rate, and that's what I've done here. As you can see, I'm using the forward rates to convert the transactions in 1 month, and that's the message I want to drive here, that even if it's not favorable, you have to still use the forward rates applicable for you. That's forwards for you all. Now, what is money market hedging? Now, money market hedging is not a derivative as such, but it's I would say a derivation of the forward. Where do we use money market hedging? Money market hedging can be used in various occasions. Money market hedging can be used when you do not have a forward. Money market hedging can be used when you have great access to foreign currency funds and your borrowing power will be much more powerful, I would say, than what a bank could offer you. So if you know as a company, then you can create your own forward, and that own forward you create will be way beneficial than the forward you can get from an external bank. That's where again you can create your own hedge. So this can be in the form of where a forward is not available, or this could be in the form where you know the hedge you create on your own, which is money market hedging, is way more favorable in terms of the rate than compared to you going and taking it from an external party. So these are the instances where you will use money market hedging. Now, what do you mean by money market hedging? What do you mean by money market operations? Two things you can do with money, simply you can deposit or you can borrow. So you're using these two aspects, deposit and borrowing, to use your deposit borrowing capabilities you have in two currencies to create the same outcome of a forward. Right? To create the same outcome of a forward, you will use your deposit and borrowing capabilities you will have in terms of a particular currency. So you want to get the same outcome as of the forward, but you are not going to use a third party here. You are going to use your own borrowing and depositing capabilities to do this. That's what you will do in your money market hedging. How do you figure out where to borrow, how to deposit, which currency you are borrowing in? Depends on the scenario. I will take you all through one example, obviously due to the time factor. I hope you can grasp the whole mechanism here through this example as to how a money market hedging question would work as far as the numbers are concerned. I'll come back to this slide to summarize it, but I'll take one scenario to explain this calculation. So this question I would want to take you all through in detail. It says a UK company has imported goods from a German supplier for 4 million euros. The payment is due in 6 months' time, and the spot rate is given to you all as 1.28. The interest rates in UK is 2%. These are hypothetical numbers, and let's say the Eurozone interest rate is 3%. How do you devise a money market hedge? Now, what do you want to do? Always think on these lines. Through a money market hedge, you want to achieve the same outcome of a forward. Now, what do you mean by achieving the same outcome of the forward? If you have a forward, you have a guaranteed outcome. You know the outcome in, let's say, if this payment is due in 6 months' time, you know the outcome in 6 months' time today itself. That's the benefit of having a forward. So you know in exactly 6 months' time, my cost would be this many dollars or pounds or whatever it is. It's guaranteed, it's fixed, it's known upfront. So if I can get the same outcome, if I can have a guaranteed amount which is known today, right, that's the same outcome of a forward as well. So that's my thought process. That's how I will want to devise this also. And remember one thing, I want to eliminate risk here. I don't want to expose myself to any form of risk in 6 months time as well, because in forwards there's absolutely no risk at all. So how do I think this? Now my thought process will be on these lines. In 6 months time, my company, I'm in UK, I have to pay a German supplier amounting for €4 million, excuse me. So 4 million euros is what I need in 6 months time to settle my supplier. So how do I think? I would have two options here. One is wait for 6 months, use my sterlings, convert it to euros at the spot rate, raise 4 million euros and pay my supplier. Option number one. Can I do it? Yes, but what's the problem? I will be exposed to a risk because I don't know in 6 months time at what rate I'll be converting my home currency to euros to settle my supplier. That's the risk I'm facing. So I want to eliminate. So in other words, I want to eliminate converting any currency in 6 months time. So what is the other option I have? Now I know somehow I have to have 4 million euros with me in my hand to settle my supplier. How do I raise 4 million, or how do I ensure that I have 4 million, is by only doing a simple deposit. So what I can do is I can make a deposit in euros today, so that the euro deposit I make today will grow to exactly 4 million euros in 6 months time. And I can take that 6 million, I can take that 4 million and give it to my supplier, transaction is settled. So I can create a deposit today which will grow to exactly 4 million euros, take that 4 million, give it to my supplier, settle my transaction. My next question, where do I get this 4 million euros? From where do I fund it? Can I use the cash in hand? Answer is no, because I don't want to disrupt my cash flow, because my cash flow is supposed to happen only in 6 months time. I've gotten a credit period, I don't want to touch my cash. So where do I fund my deposit of 4 million euros? I will fund this through a borrowing. That's why I said we will be using the money market operations. I will be using deposit, I will be using borrowing to somehow juggle it up and see how I can create this whole hedging activity. So I will fund this euro deposit through a borrowing. And in which currency should I borrow? Preferably I should borrow always in my home currency. Why? Because I know when I borrow, there's a settlement due, and that settlement should happen in my home currency, and that's where I don't have any risk as such. So I will make a borrowing in my home currency, which will get converted today to euros, and I can create that euro deposit as well. Right? So I'm making a borrowing today in my home currency, create it, convert it to euros, and create a euro deposit, which will exactly grow to 4 million euros. I will take you all through the detailed calculation right after this break. Welcome back. Coming to the calculation. So I told you all that we need to borrow in my home currency today. I'll convert it to my foreign currency required and create a deposit. That's how the process will flow. How do we do the numbers? I'll quickly take you all through this. I hope you all can see the slide as to how the transactions are happening. So my need is in 6 months time, I need 4 million euros. That's the need. I need to make a borrowing. So how do I figure out how much I need to borrow? Is by working backwards from the 4 million euros. I know in 6 months time I need 4 million. If that's the case, how much of euro should I deposit today? Right? How much of euro should I deposit today? I can rework using the future value equals present value into 1 plus r to the power n, the usual equation. And 3.941 roughly is the value of the euros I need today, and this I need to deposit. Now from where do I get the money to deposit? I will make a borrowing in my home currency sterling. How much should I borrow? I'll convert using the spot rate today, because I'll be making that conversion today. So I'll be borrowing close to about 3.079 sterlings today. So I needed 4 million in 6 months time. For that I need to make a deposit of 3.941. To raise that deposit, I need money. I make a borrowing in sterlings, and that amount is 3.079. So people, this is what happens in the money market hedging operation, and what the outcome would be is that in 6 months time, right, I'll just have to go and settle my loan. And what is the loan amount? I can use the same future value equation. I can find out what my settlement amount would be in 6 months time, which is about 3.1 million. So this is the calculation, this is all. What's happening here? Now in 6 months time, I know I have my 4 million over here. right? 4 million is there. I can take that money, give it to my supplier, my transaction is closed. What is my cost? My cost is the cost of settling the borrowing, and the cost of settling the borrowing would be about 3.109753. Do I know this amount today? Yes, I know. Is this in my home currency? Yes. Have I avoided currency conversion? Yes, I have, and therefore I have actually gotten the same outcome of a forward contract, and this is what you call as money market hedge. And you can, if you want, you can even go to the extent of calculating what is your effective rate is coming up to. Effectively, it's as if you have gotten a forward of this rate. So that's how you devise the money market hedge. And if you can, now this is actually for a payment. What is if it is a receipt? It's exactly the opposite. If you're receiving a currency, I'm not showing an example, but I'll just quickly run through it all. If you're receiving, let's say, if you're anticipating a payment, now what do you do? If you're anticipating a payment, you can't create a deposit in the currency in which you're getting. You can't do that. But the only thing you can do with an anticipated payment is that you can use that payment to settle a loan. So if you are, let's say, a Sri Lankan company expecting a dollar payment, you can use the dollar payment to settle a dollar loan. Right? That's what I will do. So I will make a dollar borrowing today, convert that to rupees, create a deposit in rupees. That's my income. And whenever my customer settles me, I will take that dollar inflow to settle my dollar borrowing, and that's done. The rupee deposit I created is my equivalent inflow that I can take it as my cash, and I have actually eliminated any currency conversions in the future. So I'm sure you all have done these studies in your preliminary activities in your classes. It's just to help you all to understand how the process flows. When it comes to exchange rate futures, now this is totally different to what forwards would offer. Futures is an exchange traded instrument. Now what do you mean by exchange traded instrument? This is not something which two parties can get together and create on their own. You have to go and trade in an exchange. We don't have futures exchange in Sri Lanka, unfortunately, but it's something similar to the stock exchange. Stock exchange is where one party is selling and one party is buying, and you just create a platform. Similarly, futures will have a platform which is it's traded, and then you can trade depending on your requirements. There are obviously pros and cons. There's no tailor-made product available for a particular company, because you're using an exchange who is trading this instrument called futures, which is standard. Because obviously they can't tailor make it to individual requirements of companies. It's a standard product. So you will, if it's let's say dollars, you will have $100,000 of futures contract. So the size of the future, it's a quantum. The size of the future is $100,000. So if you want to trade, you want to trade in quantums of $100,000. For an example, let's say if your transaction is $225,000, you have to use 2 futures contracts. Right? That's all. And you can only hedge for 200,000. The balance 25,000 becomes unhedged, because this is not a world in futures where it's created for you. It's created for everybody. So you use bulks or quantums or sets of futures, and then see whether you can make an approximate hedge to your transaction. That's how a futures exchange works. So it is standardized, and you would require a significant transaction value. Obviously, the contract size itself is 100,000. What does that mean? Minimum transaction value should be 100,000. So you're not talking about small scale companies. You're not talking about a small transaction. It cannot get applied to that sort of a company. So be mindful when you're recommending futures. If it's a small company, even if it's an SME, it might not be the case where you can have futures as a derivative. But for P, your case study company, yes, it's possible, because it's definitely a larger company. If you look at the financial statement, it looks really huge in terms of the turnover, etc. It's possible. So you have to keep that in mind as well when it comes to the applicability of futures. What are the advantages of this? It has low transaction cost. Obviously, I hope you understand why it is, because it's not going to be tailor-made for a particular company, but it will be an available contract in a standard exchange. So definitely it is of a lower cost when compared to the other derivatives which are probably over the counter. It is an effective hedging technique, especially in the case of volatile exchange rates, because this pegs the futures pegs themselves to the same volatility of the spot rate in the market. So you should be able to hedge yourselves against the same volatility of that as well. And the key drawbacks, like I told you all, is the standardized nature and the presence of basis risk. I'll explain the basis risk in a little while through a small example also, and the presence of basis risk again and the key disadvantage you have. And on top of that, like I discussed a little while ago, the fact that you cannot hedge completely using futures. I will take you all through the processes followed in doing a futures calculation and the technical definitions involved in futures. If you can see the slide now, what is futures? You will buy contracts or you will sell contracts initially, and you will do the reverse at the end of the contract period. That's what you do on futures, on a future date. These are exchange traded, like I told you all. It comes in standard currencies, it comes in standard maturity. Again, not tailor-made for you, it's just available, and you see which maturity future is applicable for you. These are some of the technical terms. You all must be quite familiar with these things. What do you mean by long position in futures? That's where if you're buying a future at the beginning. And what do you mean by short position? That's if you're selling the future at the beginning. Depends on in which currency the futures are denominated. And definitely, this is obvious. When you select a future, it has to have a maturity date after, post your transaction. You can't have a future which is maturing before the transaction is happening in your company. So this is quite obvious. What are the steps you follow? You have to determine whether you need a long or a short position depending on what you're doing with the currency originally in your transaction. I'll explain this through the next example, but you have to figure out whether it's a long or a short. If the contract currency is sold, like I told you, it's a short position. If the contract currency is bought, initially it's a long position. Then you calculate the number of contracts required. You, when you're rounding off, be careful. If it's not a whole number, you round down generally, because you always underhedge. You don't go and overhedge your transaction. You open the contract and you close the contract. That means you buy and then you sell, open, close positions, and then you calculate your gain or loss on the futures trading. And then finally, once you calculate the gain or loss, you go and execute your settlement in the transaction in the normal market as if nothing happened with futures. That's what's happening. So futures is used just to peg from the beginning, from the point you enter into the transaction. There's a time lag. Let's say in 3 months time when your transaction is happening. Within this time period, your currencies would fluctuate. You want an instrument which will peg yourself to the same fluctuations also. So you will peg yourself for 3 months, and it will give you the same impact of the currency movement in the market, and then after 3 months time you close the contract off as if you didn't have any futures. But through that transaction of futures, you will get a gain or a loss which will negate the effect of the currency exchange rate movement in the market, and which will give you an exchange rate which was the original exchange rate at the beginning, and you just come back to square one, and that's the outcome of the futures. Example on a quick note, it says a UK company has imported goods from a German supplier for 50 million, 125,000 futures are traded. So they have given you the contract size. Contract is in futures, in in euros. The rate at which futures are sold is given as well at 0.821. The question is for you to calculate the net outcome, which is in 2 months time, and they've given you in 2 months time what would your futures trading price and your spot rate would be. So in 2 months time, your futures will be trading at 0.795 in the first scenario, 0.833 the second scenario. So the first step is what? You should figure out whether it's long or short. How do you figure out whether it's long or short? Look at the original transaction. What's the original transaction? A UK company has imported goods from Germany and has to pay 50 million euros. So what would the UK company do generally if futures are not there? They will sell their sterlings and buy euros. That's what they will do. So you want to sell sterlings and buy euros. That's your first thing. Sell sterlings, buy euros. That's for your first thing. If you're selling euros, you're selling sterlings, buying euros. That's your original transaction. That's the first thing you will figure out. And then you see in which currency your futures are denominated. Now, in which currency is your futures denominated? Your futures are denominated in euros. So, euros need to be bought, and that tells you it would be a long position, because the currency in which your futures are denominated need to be bought at the beginning itself. So, it becomes a long position. Once you figure out the long or short position, next calculation is for you to find how many contracts you should use, how many contracts you need. 50 million is your transaction, 125,000 is your contract size. So it's simple mathematics, you divide and find how many contracts you need. Just a small point here, if your contract currency and if your transaction currency is two different currencies, then you have to use the futures trading price as of the beginning to convert your transaction currency to this currency in which your futures are denominated, then find the number of contracts. I'm sure you would have come across in this with these questions at your past paper analysis. Keep that in mind, very important. And then next step is for you to find the gain or the loss. Now, how am I defining the gain or the loss here? I bought the futures at the beginning and I'm selling the futures at the end. At what rate did I buy? At what rate did I sell? At what rate did I buy? I'm buying it at 0.821 and I'm selling it at the end in 2 months time at 0.795. So selling price minus buying price usually gives you profit or loss. So I'm selling it at 0.795, I'm buying it at 0.821, I sell, I buy, I make a loss. I make a sterling loss for every euro I have hedged for, because these two numbers 795 and 821 were denominated in sterling. So this is a sterling loss for every euro I have hedged for. For how many euros have I hedged for? I have hedged for 400 multiplied by 125,000 euros, and that's the total euros I've hedged for. So I multiply and get the total sterling loss I will go through, and that comes to 1.3 million sterling. That's how I calculate my sterling loss. So the future story is over now. It's as if nothing happened. I have lost 1.3 million. That's it. And then what do? I will go and execute my transaction in the usual spot market. I will go to the spot market. I will execute my transaction in the spot market as if nothing happened with the futures. So what do? I'll go and raise the required amount in the spot market. I've written this in millions, so be careful. Just when you're reading this out, it's not 50,000, it's actually 50 million. So I've written this in thousands rather. So I will go and execute this in the spot market. That's why I'm using the 0.795 rate. That's the spot market rate here, right? And then I have to incur a 39.75 million sterling cost to settle my supply simply in the spot market as if nothing happened. So that's the outcome. Finally, my net cost comes to 39.75 plus the 1.3 million loss I incurred, and my net cost comes to 41.05. What is the beautiful thing about futures? If you see the net effective rate, effectively I've spent 41.05 sterlings to settle a 50 million euro payment, and what is my effective rate? It's exactly coming to 0.821. What is 0.821? 0.821, if I go back to the previous slide, 0.821 is the futures trading price at the very beginning. So my effective rate will be equal to the futures trading price at the very beginning. Do I know the futures trading price at the beginning? Answer is yes. Therefore, I know what my final outcome in 2 months would be, and that's the outcome of futures. Ladies and gentlemen, so we'll stop it today for the part 1. I will see you all the next time to take you all through the part 2, where I will share some calculations on interest rate hedging and then some more analysis on the case study. Goodbye.